stage venture capital investing is the number one returning asset class in the United States in about the last 45 to 50 years. And it's a very interesting game. And I encourage everyone to dig into this game, dig into this field, because like I said, this is where the wealth creation, job creation, innovation is occurring in the Western world.
Only real content is gonna last. All that other nonsense is here today and gone tomorrow.
I remember you talked about just like the different types of almost strategies for VCs. There's like angel investing, there's early stage investment, and I know you named a couple of others, but could you just explain the difference between some of them and why you do
100%.
early stage investments?
100%. So let me hand draw. Let me bottom out up front. Per the numbers, early stage venture capital investing is the number one returning asset class in the United States in about the last 45 to 50 years. Cambridge Associates comes out with a report on that. I don't think I've looked at the report in the last probably this year, but and as of 2021, that was true. And that just is what it is. Early stage venture capital means like kind of seed, and even I think they're including like Series A's in that field, right? So that is that. Now, what are the different classes? I'll lay them out for everyone. Let me back up. That's why I participate in early stage venture capital, because it's the number one returning asset class. If you're going to do it, you might as well go all the way. Now, there's some unique things to be said here. Anytime you make an investment, you need to probability weight it, the expected value return, or you need another way to say you need to look at the risk that you're taking. Okay, with that investment. All right. Early stage. Now, 98% of the returns in early stage venture capital are in 2% of the companies. The majority of the returns are in 2% of the companies. That's the reality of things. So when you probability weight it, there are other asset classes that probably make even more sense to participate in, unless you have a unique network/asymmetric advantage that will enable you to do extremely well in the early stage venture capital asset class. If you don't have that advantage, you might want to go in private equity. The returns are not necessarily as good in private equity, but you don't have 98% of returns and only 2% of the companies. They're more evenly spread. There's also real estate, right? You don't have as good returns as private equity and or venture capital, but it's easier to make money. So it's easier to make 2-3 times your money. You'll never make 100 times, 1,000 times your money. It'll never happen. But you can very easily make 3 to 5 times your money. Well, not easily, but you can make 3 to 5 times your money, right? In real estate, and then there's public stock investing. We call it public market equivalents, right? S&P 500, Dow Jones, Industrial Average, Russell 3000 Index, 2000 Index, 1000 Index, right? So investing in the public markets, right? And exchange traded funds, et cetera. So I just want to kind of give you that. Private equity is a very difficult game to play. It's not something to take lightly. I kind of hinted before. I'm concerned about all the people in 2010 to 2020 that said they want to be VCs. I don't think they were methodical and thought about it. They weren't thoughtful. Some people say they were, and now it's going to be harder to make money with interest rates going up. A lot of people are going to wash out of being VCs. They just are, 100%, right? Our lives are on the line of AIN. To me included, right? So it's not. I'm just not saying they. No, but I'm confident that I've been thoughtful and I prepared for this, right? I've had this on my mind since I went to the number one business school in the land when I went there, University of Chicago Booth. And then I was an investment banker for 6 years. I was advising startups and incubator programs and accelerator programs. I still do that. I'm a Kaufman fellow. Been investing for years now, right? So I prepared for, like Game of Thrones, winter's coming. I got my coat on. You know what I'm saying? So, whereas everyone else, they got on flip-flops, they on slides and Nike shorts. you know,
Right.
and the wife beater, and it's going to get cold, you know, and I don't know, you know, we're not on the beach anymore. So, you know, that's that. Now, so I just want to kind of give that hint, you know, that not hint, but I want to give that, you know, disclaimer on VC, or early stage venture capital. Now, when it comes to the different asset classes within VC, or the different levels of VC, there's angel investing, right? Friends and family. You'll probably, let me get some dollars. You'll probably, you know, it depends on how wealthy your friends and family are, right? But you're probably looking at less than $250,000 or less of capital raise. So you're literally going to you know, brother, sister, uncle, aunt, second cousins removed, parents, wife's family, your girl's family, your people you went to college with, anyone you can to raise some capital at that friends and family round. So that's your initial round. I got an idea. I love some money, so I can start building. Cool. The next round is the angel round, and there are serial angel investors. And these people put in real money for, you know, people put in anywhere from, you know, $5,000 checks to $200,000 checks, right? As angels into company, and there are angel groups that have come together and give someone $1 million, right? And so a lot of angel groups are affiliated with different universities and et cetera. And you know, little private investment clubs. The private investment clubs have also kind of effectively been around since humans have been around and civilizing, right? To some way, degree, way, shape, or form. After angel investing, and that's what I was initially. That's how I started and built my track record. I was an angel investor. I actually have never truly been a friends and family investor. I've looked at potential investing at that level, but I've actually never pulled the trigger wisely. We actually call it friends, families, and fools. That's what that round is. So the angel investing, there's friends and family and fools, there's angel investing, and the next thing is pre-seed investing. So pre-seed investing, you'll probably see a check of, you know, $500,000 to $750,000. It could be as low as $250K. You know, the company will typically be less than $10 million in value. It could even be as low as $4 or $5 million in value, right? Company has no traction at all, right? And so that's the key to pre-seed investing. To understand if you got a pre-seed company is the company has no traction. That's a pre-seed investment. Okay. Then there's seed stage investing. Seed stage, you'll see typically companies raise between $1 million and $4 million, right? You'll see companies raise between $1 million and $4 million. They are typically going to be valued at, you know, $25 million or less, right? We actually we are early seed investors, so we try to get at $15 million or less for AIE Ventures. This is where you get real institutional capital, hardcore looking at how your company's performing. And at this point, you either have initial traction for your company, or you have a company that is going to take a while to actually commercialize. The technology will take a while to commercialize. But what you're doing is you are, what you're doing is you are developing the product, and you have evidence that the product is developing and is on the path to eventually be commercialized. So either that is occurring, or you already commercialized and you are finding traction in your company. There's a concept called product market fit, right? Mm-hmm. And if product market fit should be assessed by looking at financial metrics of how the velocity of that product being purchased and how that product is being utilized by the customer. Okay. And this is at the seed stage. Typically, you have traction, but you're in the pre-product market fit phase. So the pre-seed phase is to give you money just to go build the product. The seed stage is to give you money to go find product market fit. Go explore different customer segments, examine how your product is being utilized by those customers, how they're buying it, et cetera. And then we can try to find to say, hey, I have a point where I know I have a product and it's measurable, observable, and repeatable as with respect to how to sell this product. Okay. The next stage is Series A. Classically, Series A, you're looking at probably raising between $10 and $20 million, right? And for these rounds, you say, what is the value of the company? Typically, in each round, you sell about 20% of the company. That's about what you do, right? At the Series A stage, you should have product market fit. You should have the financial metrics that helps you understand that this company has product market fit. You should be looking at lifetime value of the company relative to customer acquisition costs, like LTV to CAC. You want it over a certain amount, repeat customer rate. I have a whole Bible of key performance indicators that I utilize, and I quickly look, and it is literally the same thing as looking at an athlete in the NFL draft or in the NBA combine, right? An NFL combine, that's 40 time bench press, lateral movement drill, vertical jump. What's the other metrics? Broad jump, right? You just have these KPIs, and it depends on the business model of the company and the kind of company it is. But for each different kind of company, you have these KPIs. And look, either you ran a 4.2 or you ran a 4.5. I don't know what to tell you. You know what I'm saying? You run a 4.2, you're a first round draft pick. You run a 4.5, you might go fifth round. It just is what it is, right? And so at the Series A, no, for real. At the Series A, it's just straight up. It should be at that point. Hopefully, you have metrics to go off of. The company should have product market fit, and what you're doing is you're giving the money company to expand their sales force, right? So that they can go and because their sales processes at that point should be measurable, observable, repeatable. You're giving them money so they can just expand sales. Right. So that's what's happening at that stage, right? Now we invest in companies that are deep tech. So those companies may not have, even at the Series A, may not have a product that can be commercialized. It's still developing a product, but we at least have a sign that that company is close to commercialization, right? And honestly, even for a deep tech company, you should be pretty close to commercialization at around the A. Oftentimes, it may not actually get commercialized until around the Series B or Series C level, but you should, at the A, you should know you're within striking distance, right? Mm-hmm. Now, the Series B is a really interesting, we call it the treacherous D, right? At that point, you could be raising anywhere from 30 to 50 to 60 some $1 million for the company. Again, you want to sell 20% of the company so you can back into the math there. Just take whatever number I gave you times 5, right, to get, to the value of the company. Mm-hmm. And at that point, at that Series B level, you should start to care a little bit more about unit level economics, right? So, because and you start to care about that because is this company within striking distance? Does it have a path to get to profitability, right? That's what you care about. That's what you should start to care about at that level, right? For the deep tech companies that we have, the very science forward companies that we have, they very well may not even be commercialized yet. But at a Series B, that technology should be very close to going to market. If not, and honestly, if it's not in market by the B as a deep tech company, it's something to be worried about. Unless it's something really bleeding edge, right? Like fusion technology or something like that. Hey, you just may not quite be there yet. But so that's that. Now, if you do the math, you say, let's say 50 for the B, 20 for the A, that's 70. Let's say at the seed you raise 5, that's 75, right? And the pre-seed, between the pre-seed and angel, you raise another $1 million. So you got just shy of $100 million into this company already to get it going, right? Which is why, for the capital, you're looking for unicorn exits to actually justify the risk that you're taking to invest in that company. Remember, every investment decision should be risk weighted, right? The number one and most important thing to consider when making an investment decision, other than the human being, the number one most important decision to be made when it comes to an investment is what asset class you want to invest in, right? Right? And then what kind of risk are you willing to take within said asset class, right? That is extremely important. All right. Okay, so that's the Series B. Series C, you're going to see a company could raise $100 million at that point, right? At this point, you're starting to identify what kind of exit is this company going to have. And the VC should be thinking about that earlier, but at that point, it should be a little bit more clear. Is this company on a path to go public via an initial public offering? Or is this company on a path to be acquired, simply acquired, right? And then how the company is set up is different depending on that path, right? And then and at that Series C level, you're at about that growth equity stuff. And anything at that level or beyond is called growth equity. That's a different kind of investor. You see a lot of private equity firms actually participate at this level. And you could have a situation where the company is actually profitable at that kind of growth equity level. You totally could have that ability, right? And at crossover rounds, the companies that invest in companies that are about to go public, their next round is going to go public. So you're prepping that company to be owned by retail shareholders and large institutions, like the ones that run their control 401ks, pensions, or us when we go on TD Ameritrade and go buy stock, right? And something we're interested in, right? So, that was a little long-winded, but that's pretty much how those are the different kind of elements of venture capital, how things are laid out. And it's a very interesting game. And I encourage everyone to dig into this game, dig into this field, because like I said, this is where the wealth creation, job creation, innovation is occurring in the Western world.